In a renewed trend, the Nigerian economy is experiencing more banks offering financial aid to the private sector. This comes as a result of the implementation of several initiatives which were developed last year in the first annual Bankers Committee retreat. Access Bank CEO Aigimokoje spoke with CNBC Africa about the progress of these initiatives. What impact does the committee expect these bonds to have in terms of loan creation in 2011?
I think if I take you back to our 2009 retreat, we found that the first step we had to take was a paradigm shift in our minds and a collective decision that we wanted to focus on the real sector as opposed to, if you like, more speculative sectors such as the capital markets and so on. And we emphasized agri, transport and power. If you notice, something about the real sector is that you need low-cost, long-term financing, and really the only realistic way to address these sectors from a financing standpoint is through bonds. In the immediate term, what has happened is that pending and given the fact that we have a quite shallow capital market, the central bank has stepped into the gap and has arranged bonds, through the Bank of Industry, and will also do so through other development finance institutions. And so it addresses the issue of interest rates, low interest rates, as well as the issue of long tenured money. Already significant transactions have taken place in terms of refinancing the manufacturing sector. If I speak for Access Bank, I believe that we have at least 4 captive power transactions in the power area. And all of a sudden you find that, interestingly enough, Nigerian banks now begin to have lending to agriculture as part of their sectoral focus. You see this in their analyst presentations.
How do banks plan to mitigate the risks involved in investing in areas like agriculture and manufacturing, given their perception as high-risk investment?
There are 2 types of risks when you look at the real sector. You have what you can call transaction risks, right? And those you mitigate by transaction structures, looking at the obligors and so on. But the risk that's of most concern is the environmental risk around issues of political risk, social risk, and so on. And this is why we've been advocating strongly for government to put in place the enabling environment that will allow people to do transactions and focus on the transaction risks. A bank can solve the transaction risks or address the transaction risks. A bank cannot solve the environmental or political risk issues. Those are government risk issues to take on. Now, if we assume, for example, in the power reform area, that the signals that have been sent through the reform program that the president unfolded this year, if they see them through, definitely the power sector, from an environmental risk perspective and a political risk perspective, will be significantly de-risked and will therefore be attractive to banks and international lenders, to participate.
When can we expect to see the effects of funding in these areas?
Well, to be frank, you're already beginning to see it. We've been a bit shy about whether we should, publicize the testimonies we are beginning to hear from the, medium-scale enterprises who, as a result of the refinancing and restructuring of their loans into single-digit long-term loans, now have a second lease of life. Hundreds and thousands are being employed who would probably have lost their employment. Maybe, perhaps, we'll be more aggressive, or, if we're a bit more. We spend a lot more time on communicating the benefits, to the economy.
How much money has gone into funding these sectors?
If I speak for the SME refinancing scheme, I believe that's about 200 billion in terms of the program value. I know at least 75% of it has actually been disbursed. If I speak for the power, of which there's a 300 billion aggregate fund, the deal pipeline that I hear of, should be able to take up about 50% of that amount over the course of 2011. Those are significant sums. But what I want you to think about is that if you think about power, for example, in a typical power transaction, you see a relationship between debt and equity of anywhere from 50%, 50-50, to maybe 30-70, where you have 30% equity and 70% debt. But what these programs do is they leverage financing. So actually, a 300 billion power fund can actually support as much as 3,000 megawatts in new, power generation. And that's the type of effect it will have.